Hello and welcome back to the Way Home podcast. My name is Annie Bender and I'm a realtor here in Maryland with the Weymouth Group of Keller Williams Realty Center.
And I'm Chris Weymouth, director of the Weymouth Group and also broker designee for KWRC in Maryland.
Thank you so much for tuning in today. If you are liking the Way Home so far, please be sure to like, subscribe, and share with someone you know. It helps us out so much. So let's get into today's topic. I've heard that there are some fears of this being 2008 all over again.
And you're not the only one. Actually, the news media, some out there are doing some comparisons to that. But in totality, the news media is getting it. They really do. The more experienced agents, the one who went through the past market, who are experiencing this one, if they're still around, who are experiencing this one, say now, there's no comparison at all. But unfortunately, you have a lot of buyers and some sellers out there who are buying into the media and the fact that this could be the same kind of market where we've had this total implosion of the real estate market.
Yes, so we want to talk exactly about what happened in 2008 and why today is a totally different market. And you, Father, have actually been through the 2008 housing cycle. So we want to talk about what you remember and what happened. And I remember Mom saying she remembered September 2008 when the phones just stopped ringing.
Exactly. I like to say Elvis has left the building. Da-da-da, da-da-da. Yeah, it was a very difficult market and for several reasons. One, that was our business. All right. Mm-hmm. Two, and we are also experiencing that with our home. We made a killing on our home that we sold in Turf Valley. And then, of course, the seller of the home that we bought, they made a killing. Yeah. Right? So with that being said, we experienced that. It was when the subprime market crashed, and we'll go more into detail about that. When subprime market crashed, it was very hairy. It was defined as the Great Recession.
So without any further delay, let's jump right in. And first, we wanted to go over lending requirements. So it's known that lending requirements back in 2004 were very different than they were today. And I recall you saying that the Clinton administration sent out a message to the banking industry in a speech that he wanted to make it easier for people to own homes. So what is the key difference between then and today, and how does that affect the buyer's market?
Sure, absolutely. Well, that message was a subtle message when Clinton gave the speech. Herbert Hoover, when he was running for president, he said, I'm going to put a chicken in every pot. So Clinton's speech pretty much disseminated the same kind of message to any possible homeowners. So with that being said, the lending requirements for the banks eased up. In a nutshell, they put a mirror under your nose, and if it fogged up, you got a loan. The two that come to mind were the no-doc loans. Those were the people who were in commission, were one, and the liar loans. And the liar loans, well, the no-doc loans, you didn't have to give as much in documentation to support your financial viability to buy the home. But the liar loans were exactly that. You were encouraged to lie on your application by lenders.
Wow. They
were. And so it was an unfortunate situation. And in order to get those loans, you also, a lot of them who could not get the house or could not get the house before, they didn't have enough cash. So they were required to do private mortgage insurance. And so that's what we call the subprime market, private mortgage insurance, and also the 80-10-10s and the 80-15-5s, where they were the second loans. Oh. Okay. So the insurance companies, or not the insurance companies, mortgage companies, they had insurance on their loans. Mm-hmm. So we, as a homeowner, and we all know that if you own a home, you put down less than 20%, you're required to do PMI, private mortgage insurance premium, and then you are required to pay that insurance premium on behalf of the lender. Mm-hmm. So if you default, they get an insurance, just like an insurance on your home, that if you get your roof gets messed up, call the insurance company, they replace your roof.
Also, I wanted to ask, were ARMs more prevalent then?
They were. Those people, in order to increase their viability, in order to get the property, they were lower income. So what did they do to qualify them? They qualified them on ARMs. And an ARM is an adjustable rate mortgage, and you can get 1-year ARMs, 3-year ARMs, 5-year ARMs, 10-year ARMs. The more popular ones were the 3-year and the 1-year.
Mm-hmm.
So, and the way that works is that if you get say the prevailing rate at that time, maybe 5.5% and 6%, which they were at that time, between 5 and 6%, you would get an interest rate that was lower on an ARM that would start you out at 2%. That qualified you right there in order to get that. You couldn't qualify to 6%, hence the liar loans, the amount of money you can make. So, all right, you certainly do qualify for that ARM. Well, you know what? There's a day of reckoning, and that day of reckoning came when that first adjustment came. Now, with the adjustable rates, it can only go up 2% each year, and then it caps out at a total 6, 7, or 8%, typically 6%. No, 6 points, not percent. So in the first year, well, at the prevailing rate being 6%, you got a 2% mortgage, boom, it goes to 4%. So your payment went up considerably. And those people did not have the income to cover the mortgage payment.
So, and from that, and from the liar loans and no doc loans, everything like that, we started seeing that people were delinquent on their payments.
Yes.
Right?
And you use Maryland as an example. You're not delinquent until you are 45 days delinquent. Mm-hmm. And then what happens, foreclosure proceedings start in Maryland. So it has to be 45 days that you're delinquent. And then for another additional 120 days, they're allowed to go ahead and sell your home on the court steps. And it was a process. It's a very emotional process. Buyers or homeowners were calling the banks and calling the loss mitigation department in order to try to stave off the sale of their home, and they were doing everything they can in order to make that happen.
So with these delinquencies, was the crash like a wave, or was it more of one day the shoe dropped?
Yeah, that's a great question. A lot of people think when they think about the loss mitigation department at a bank like M&T Bank and Wells Fargo, they think that with this massive room with all these people on this desk and computers, and no, it was a size of a room like this, 2 or 3 people in an office. And before the crash, they had delinquencies, but nowhere near of what they didn't see the tsunami coming. Mm-hmm. And there's a stack of papers like this, and they had a whiteboard that basically showed who they're working with and loss mitigation. Then all of a sudden, boom! It was getting crazy. They were getting calls and things like that, and delinquencies were coming in, and they were up to here, and they didn't really know how to handle the volume of the delinquencies, which led into short sales. And then I have a great story for you that we can get into a little bit in this podcast about how the short sales started to disappear, but foreclosures started to increase tremendously.
I remember you wrote a blog about short sales previously, and I would love to hear your take on exactly what happened.
Yeah, I remember the title of that blog was, Dumb as a Fox, talking about banks and how the short sales were very prevalent, and then they started to ease off. And what happened? So the short sales, and most of us already know, is that you're selling the home for less than what the mortgage is due. So a couple of bright real estate agents started to do that. They would list a home for less than what the mortgage is. And then from there, they would go ahead and get a contract because it's a very attractive price based upon the short sale. Submit that to the bank, and the bank, the loss mitigation department would say, "Oh, what's this?" And it said, this is a short sale. You're going to be made whole partly on your mortgage. So in other words, if the house was, the loan was $500,000 and they got an offer for $450,000, the bank was going to get partially whole on their mortgage because they had mortgage insurance, right? And you didn't see a lot of these if people put 20% down when they bought their home, because at that juncture, at that point, they've already had They weren't doing liar loans and they weren't doing no-doc loans. It was the people who were putting down little money. So as the market started to change and the prices of value of the home started to go down, their homes were worth less than what the mortgage was.
When the bank would accept a short sale, let's say it was the $500,000 that they were owed and the short sale was for $450,000.
Mm-hmm.
So private mortgage insurance would then pay the bank that $50,000?
They would pay the difference. You had $50,000.
Okay.
Yeah.
So then they were getting back exactly what they were owed.
Exactly. Yes.
Got it. So if short sales seem to be working, why did they start to slow down even though we were still in the middle of a Great Recession?
Great question. Well, we all know that who really controls the company is not really the COO or CEO, it's the CFO, Chief Financial Officers. So all the accountants were seeing, oh my goodness gracious here, they're selling these properties. And in some cases, or the insurance, we talked about the insurance covering it. I should retract on that. In most cases, the insurance wasn't covering it because they were made whole on a certain percentage of the note.
Got it.
So the accountants were going, wait a minute, what's going on here? And not that they were dumb. They knew what was going on. But you have to think about at that juncture for about maybe 10, 20 years, the mortgage companies and banks have been wanting to sell homes. Mm-hmm. They wanted to get into the real estate industry. And the National Association of Realtors is a very, very strong union. So they got Congress's attention and was able to tell the banks to back off. So can you imagine walking into a bank lobby and over to the right is your mortgage company. It's a mortgage department. Over to the left, over to the right is the real estate company. Mm-hmm. The real estate brokers are going, oh my goodness, we will get buried in this. So the banks have always wanted to get into real estate. It just makes perfect sense. It's a good marriage. So what happened is that all of a sudden the CFO told the powers that be, said, listen, we're able to get into the real estate through the back door. And how did they started doing that? Now, let's talk about the conversation that the loss mitigation department has with a borrower. And they would call up and they go, hi, Annie, just want to check in with you. Do you still want the home? And you would say, yes, I still want that home. Great. Are you taking care of that home? Yes, I am taking care of that home. Do you still want to live there? Yes, I do. Well, we're doing everything we can in order to make this short sale work. Hang in there, take care of the home, mow the lawn, pay the electric bill. Don't worry about your monthly payment. We're going to work on that for you. Well, the whole time what they're doing is remember I told you about the 120 days from notice of foreclosure to the point where they get on the court steps and they're auctioning the home. Well, they're buying their time. Those 120 days, what they're doing is that they are saying, all right, we're going to take this home. They're giving all the assurances to the homeowner that we're not going to take your home, but the whole time they're trying to take their home when they go to auction. Now,
so they're encouraging the owner to take care of the house, still treat it like it's yours.
Yeah, why do you suppose that is?
Well, I mean, I've heard stories of foreclosures where the owners are so upset that they totally trash the home.
Right. The bank tells them ahead of time, like, you know what, we're not going to work with you. So
they turn on the faucets and leave.
Yeah, turn on the faucets, plug up the sinks, and just walk out and flood the homes, take out the appliances, remove the cabinetry, just destroy the home because they're angry because, they just felt as if it wasn't fair. So what happens is that getting close to the date of foreclosure, they get nailed on their door their mortgage document that said that you promised to pay. And if you didn't pay, we were going to take your home. And that's still like around a 7-day or 10, 12-day notice. And oh my goodness, the first thing they do, they get on the phone with the loss mitigation department. Oh, wait a minute. You said we're going to be able to keep our home. And they say, oh, don't worry about it. We are required by law to give you that notice. So don't worry about it. You still want your home? Yes, I still want my home. Are you still paying your electric bills and mowing the lawn? Yes, I'm still paying the bills and mowing my lawn. Great, thank you. We'll be working with you. Well, then what happens is that home that's valued at $500,000 and their loan amount is $550,000, the bank forecloses on it. They now take possession of a hard asset. All right. So that $500,000 mortgage that's defaulted on, the mortgage company pays off that mortgage. Now they're whole on that mortgage. All right. So they got to pay back. So now they have a hard asset that they paid nothing for. They have a house sitting in their warehouse in the back, so to speak, document wise. Now, the REO properties, real estate owned properties, you heard REO means real estate owned properties. What they started to do is that they started to take an inventory. And then when they put the house on the market, you would see in the remarks that now the banks cannot force you to go with as them as a lender, but they would hire a real estate agent, and the real estate agent would spruce the home up, just make sure it's all taken care of, pay the bills. They'll reimburse the agent for any bills that they have paid in order to take care of the home. And then they'll put the house on the market at market value. And in this particular case, probably maybe $500,000. And then they would sell the home, but make it a requirement of the person who's buying the home to do a loan application with that bank. Now, it doesn't mean they're going to get the loan, but there's greater percentage that they were getting that loan. So now they're getting a $500,000 mortgage. They've got a $500,000 asset, and then they sell the home for $500,000, and so they've made around $1.5 million on the home.
Wow.
Yeah. So that's why short sales started to fall off, because I remember agents going, I don't get it. We gave a great offer for this home. Why didn't the bank, take this home? It was great, but it was less than what the bank was going to take it back for. They just did the math. The banks did the math, and they had a formula. It cost each bank $65,000 in order to take back a home. That's the amount of money it cost expenditure-wise in order to take back a home in foreclosure. And based upon that math and value what they could sell it for and the chances of them getting a note and being whole on the mortgage that was defaulted on, it made great business sense.
So we saw predatory lending happening, which then led to foreclosures and then short sales. So then we see the Dodd-Frank Act, right?
Right.
And this is how the government stepped in to make sure something like this wouldn't happen again.
Right.
Right. Can you tell us more about it?
Sure. There's a good movie out there called Too Big to Fail. That was really good. William Hurt was in it, one of the actors I really like. And it basically talked about, just to sum it up, is that the U.S. government, in order to be the hero, in order to stave off the Great Recession, they had to shore up the banks. So the Morgan Stanleys of the world, who were the insurers, and the Washington banks and so forth, who ended up defaulting anyway in 2017. The other banks, the larger ones didn't need the money, but the smaller ones did, and especially the ones that insured the loans, they needed the money.
Yeah.
So what the government did is they forced all the banks to take the money that they were giving the banks in order to shore them up. Now, why didn't the big banks want them? They didn't need it. They were making money. They really were. And they were foreclosing on homes. They were making money. The people who provided the insurance, they needed the money. So they had a meeting with all the large banks, according to this movie. And they said, you are going to take this money. Well, we don't want this money. So, yes, you are going to take this money. It's because the government wanted to look like the hero at the time. They said, look what we're doing to stave off here the Great Depression. And so the banks just held on to that money, put it away in another account, and then paid it off in around 1 year, 2 years, 3 years, whereas the other banks kept the money that needed it. So because of the subprime defaults and the predatory lending that went on, Barney Frank and I can't remember the other. I was going to say Lance Dodd. This is shout out to Lance Dodd. I went to high school with, but there were the other gentleman was a senator named Dodd. They put together legislation that curtailed the predatory lending, aspects that got us into this big trouble. And some of the things that were going on is that they put up a big wall between the appraiser and the loan officer and the underwriter, because the loan officer would get in the underwriter's ear and the underwriters would get into the appraiser's ear and say, listen, get value, raise value up, because the market appraisals weren't keeping up with the houses pricing going up like this. So they had, in order to get the loan approved, they had to basically tell the appraiser to lie. And they had in-house appraisers. So there was a tremendous amount of unscrupulous activities going on in the bank. So what the Dodd-Frank Act did is that they separated, put up a wall between them, and then required the appraisers not to be affiliated with the bank. And then it also required that the appraisers that they rotate, they'll have, depending upon the size of your bank, you had to go through and rotate.
Like
and
a pool of appraisers?
A pool, yeah, like the old secretary pool, yeah. And so that's what they used to use. And that's one. And then two, got rid of the liar loans, got rid of the other type of loans that are out there. And it put the onus upon the lenders to ask for a tremendous amount of more documentation, which slowed down the process of getting a loan. But in 2018, they got rid of some of those requirements, eased it up, because it was just ridiculous, some of the things that made them required. I mean, I remember getting a loan and they said, what is this $3 check for? I'm like, oh my goodness, are you kidding me?
So the Dodd-Frank Act helped us get out of the Great Recession.
Sort of, yeah.
Sort of.
Yeah, sort of. Yeah.
It helped lead the way.
It helped lead the way, gave more confidence to the consumer that was out there, because the government helped. There's one case where the government did help in situations like that.
So then, besides that, what else helped us get out of that Great Recession?
Well, you remember that banks, when they were buying these properties, they were very, not choosy or picky, but they were strategic on what properties to foreclose on. And some of the properties that they did not buy were the homes that were based upon certain locations and the condition. They didn't want them. What happened is that investors started flying into the market. And, you'll be posting this map and it will show these numbers, which is crazy. In this map, you'll see that all of a sudden, when we started getting out of this Great Recession, the interest rates went down. They were running between around 3.5%, and the investors started flooding the homes with these flips. So when you look at the map, what you're seeing is the increase in median price, and also you're seeing an increase in sales. So for instance, in the upper Northwest, you're seeing 18 to 24%, and in the lower part of California area, 20 to 30%, 20 to 30% up in the Detroit area and things like that. Florida, 14 to 20%. I think Florida was a little bit higher than that. But you're going to see something there in the upper Northeast, where it encompasses D.C. and New York and everything else like that. It was only 5 to 6% increase in median sales, and also in price. And why do you suppose that is?
We had nowhere else to go.
Yeah, because the prices were already high, and the foreclosure rate was already low in this area. All right, all these numbers over here represent the foreclosure rate and the drop in pricing. That area where we are, there was less foreclosures, and the prices didn't adjust as much.
And why is that?
Well, what happened is that the Northeast had nowhere to go. Foreclosures were nowhere near the rate as the rest of the country in our region. This was one, and then our prices were already high. So if you were buying these homes or getting these homes off foreclosure, they weren't selling that much higher at a price in totality. So that's why it was only like around 5 to 6% increase in median price, and also in sales, because we are already, and also the less foreclosures, because this particular area has one of the greater populations of income wealth. It was greater than any other part of the country, because look at Howard County. It's one of the richest counties in the nation. Fairfax County, one of the richest counties in the nation. So that's why it just didn't increase that much.
So just like coming out of the Great Recession, when there were those strong and strict lending requirements, we're seeing the same thing today. I know you mentioned in 2018 they let up a little bit, but still there's not that predatory lending that we were seeing before. Right. So everyone that's been buying a house in this time where we've seen such an increase in prices, everyone who's been buying the home has been extremely pre-qualified.
Absolutely, more cash buyers.
Right.
So
then besides lending requirements, what are the other differences that we're seeing today compared to 2008?
Well, for one, we're seeing less supply. And there's many reasons for less supply. Sellers just did not want to sell. We're also seeing less buyers too, but that still did not stave off the fact that the buyers who are out there today are extremely motivated. So we're seeing a low supply for many reasons. Sellers are holding on to their homes a lot longer because prices are starting to increase. They're like, where am I going to go? The other thing we all saw, the buyer pool decrease tremendously because they wanted to rent. They wanted to be freer. That they psychologically, they saw their parents go through this housing market, or they read about it, and they didn't want to be tied down to a mortgage. They didn't want to get anchored to a loan. But you know what? They were still in certain areas, and it was going crazy. And then all of a sudden, COVID hit. That was the trigger. When COVID hit, all of a sudden, everybody wanted to stay home. As rents were going up too, we saw rents going up. So now these people this very affluent buyer pool is hitting the market. They're making money. They have a little more savings than the generation before them, and they aren't stigmatized by the Great Recession. So in 2022, in the beginning around 2021, we just saw the market just start to shoot up, housing prices going up because of low supply, but the buyers were out there, were motivated. And with such low supply, the buyers were out there looking for home, and boom, the prices started going up like crazy. And so now we flash forward, and we all know that. You know, I'm not saying anything that anybody doesn't know because it's recent history. Then all of a sudden, boom, 2023 hits, toward the end of 2022, and the market starts to change. And the reason why that happened, because of COVID. COVID caused this foray of all this buying and everything else, and also caused the slowing of the market. And why is that? Supply chain issues. It caused the inflation. We saw everything getting more expensive, transportation getting expensive. The CPI, the Consumer Price Index, started going crazy. And so people were still buying homes, but they didn't really feel it in their pocketbook until later in 2022. And they went, you know what? I'm going to not buy a home. And so that buyer pool that was out there has shrunk considerably, but so did supply. It was almost like the buyer pool and the seller pool started to reduce at the same time.
So then let's get into prices, because we saw crazy increases, especially spring 2022. And we've talked about it before in, I think it was May or June, where there was increases of 25% year over year. And also, like we've said before, the Fed stepped in and raised interest rates, so that way mortgage rates would be going up too, to try to bring us to a
soft landing.
Yeah, soft exactly.
Landing. Yeah.
And would you say it's working so far?
Yeah, I'd say yes. Or some people say that the Fed raised the rates too much. I mean, in 5 consecutive quarters, they raised it 0.75. The last one was 0.5. And I believe, personally, I think it's working. I really do. I think it's working. But we're not going to really tell and see what the effect is going to be until we're deep into this next quarter. February is going to be the real tell.
One to watch.
Yeah, February is a real tell. Because what happens is that in January, we're seeing an increase in inventory typically. But I don't think we're going to be seeing that much of an inventory increase. It's only seasonal, because the people who put their homes on the market typically do it after Thanksgiving and Christmas. They don't want people traipsing around the house during the holidays. They want to put up the tree, have turkey and the ham and everything. Don't want to be people walking through their homes. And typically the spring market was happening in March. And every year since, I guess, for the past 10 years, we just saw a slow creep of the spring market happening to go from April to March, then to February, and then the first couple weeks of January. Well, we're in the first couple of weeks of January, and I'm looking at the supply, and it's nowhere near what we typically see this time of year. It's a slow. It's not that much of an increase. So what does that mean? I think what it means is that so we're going to have less buyers out there because of the interest rates, but you still have a low supply of inventory. So it's the same old, just on a smaller scale.
So as we're talking about home prices, we have this chart here from Dave Ramsey that I'll put on the screen now. And it shows the median home prices versus the months of supply. 2008, we had the crash, and then all these homes started flooding the market like we talked about. And then over time, we've seen supply continue to decrease. Can you tell us why that is?
Sure. People are just staying in their home longer. The average time people stayed in the home was 7 years. That number started to increase. So as people stayed home longer, supply went down. And of course, at this time also, it has a little bit of a factor. It has a bigger factor today than it was back then, was new construction. You're seeing that new construction, the local municipalities started putting a squeeze on the builders, and we call that impact fees. And local communities saying, I don't want any more building in happy acres and so forth. And so new construction started to stave off. So new home starts started to curtail a little bit. But also sellers just wanted to stay in their home longer. They really did. And then when they did want to sell their home, you're seeing that the buyer demand started to increase.
I know there's talk among some people where they're hoping for prices to crash. But we won't see any sort of considerable drop in prices until we see an increase of supply, right?
Correct.
And a decrease of buyer demand.
Right.
And as you just said, we're seeing a decrease of buyer's demand while we're seeing a decrease of supply.
Right.
Right. So now as we're wrapping up, let's pull out the crystal ball.
Oh, that one. All right, my old jalopy here. I got it right down here. So here it is, the crystal ball. Everybody, this is what the market's going to do. And it's probably not going to work now. So
you've done several predictions on the market so far. Now that we're nearing the end of January, is there anything new that you wanted to add to your previous predictions for the 2023 market?
No, I don't. It's really going to be the same old, with the exception of I think we're going to see still a little bit lower supply because the only reason why we'll see any increase is because the aged population is just moving to areas where there's less tax. People are retiring and so forth and things like that. Some buyers are going to wait for the interest rates to go down to 3 or 4%. That's not going to happen. Not going to happen for several years, in my opinion. We might see something, and I mentioned this before in our previous podcast. I know we repeated some things in our previous podcast, but we're going to see interest rates go down, probably 5 at the end of the year, but we're going to still have a supply problem.
And then what are your thoughts on an oncoming recession?
We're not going to really tell until I think February.
Okay.
Yeah, we're going to have to see what February numbers look like and see what the Fed does.
So then what would you tell a seller today?
I would say that think about where you want to be. And they're still going to get pretty good value for the home. And we said this before in the last podcast, is that they really still need to upgrade their home. You showed a home today that was a little bit longer on the market because it was a little bit long in the tooth. And if it had everything in it, they probably would have gotten anywhere between $30,000 to $40,000 more and been on the market less. So, we still recommend sellers to do that. So just take care of the big things, take care of the roof, take care of HVAC, take care of the windows, make sure you have your fireplace inspected and take care of that deck, and then you should be golden.
And don't get too exotic with your upgrades.
Yeah. And take down the balances.
Well, thank you again for joining us today for the Way Home podcast. We hope you found this fun and informative. Remember to like, subscribe, and share with people that you know so we can help more people out there as they're looking to buy and sell homes. And if you or anyone you know is looking to buy or sell in Maryland, we are here to help.
Yep. Oh, yeah. Call us right here.
So thank you for joining us, and we will see you all next time on The Way Home.